Hello and welcome to this week's Strategy of the Week tutorial on identifying deceptive market tops. My name is Steve Chappell, the Director of Educational Services here at VectorVest. Well, I'm sure the past 5 weeks of market volatility have certainly perplexed many investors and traders out there. But you don't have to be one of them. It's times like these that you need VectorVest more than ever, so you can rely on our proven market analysis and market guidance. Our guidance will help you identify and navigate deceptive market tops like no other service out there, or any market condition for that matter. But again, we're going to key in on deceptive market tops for the purposes of this presentation. Let's jump right in the program and take a look. So here we are at the home page for VectorVest 7, and on a current basis we can see the needle is pegged into the red. It says here that the color guard is bearish and VectorVest does not advocate buying any stocks at this time. So the guidance right as of today is just absolutely spot on. But of course that doesn't tell the whole story for the last 5 weeks. To begin to dig into that, let's take a look at the color guard just below to kick things off. So I'm going to go from a small view into a medium view. This will allow us to see the last 3 weeks of trading activity and get a better pulse for exactly what the market has been doing over the last 3-week period. Here we can see a market that has transitioned from a lot of weakness beginning the 3 weeks ago into some strength and back into more weakness. And it's just this type of market that can drive investors nuts. We find ourselves looking for any glimmer of hope to begin buying stocks again as the green lights appear in the color guard, only to find ourselves with, in some instances, horrific losses just a few days later. So in the presentation tonight, we're going to try to alleviate that problem for you. And believe it or not, we can even really do it right here in the color guard. While we see an awful lot of transition in the color changes of the color guard, there's really some important information to pick out right here for just the last 3 weeks. I'll draw your attention to the little stars next to certain red lights. It's here that we had confirmed red lights. In other words, even more reassurance that these red lights are severe warning signals. And that began just over the last 3-week period with the very first red light on March the 26th. See, these are times where you can pick up bearish positions that make money in a downward trending market. Wouldn't have these 3 instances of confirmed red lights been a great idea to capitalize on what has been a substantial downward spiral, particularly as of late? But you know, the last 3 weeks doesn't tell the whole story. I really want to focus on about the last 5 weeks to tell you the truth. So to do that, we're going to move over into one of the most important graphs in your platform, and that's the market timing graph. To get there, I'll go right up to the graphs tab. Over on the left, we'll change it from stock to market timing. Here we can see just a 1-year look back that we've had a terrific run in the market over the last 1 year. We'll also notice that we did in fact hit a high right up here on March the 7th of 2014 and have really been working our way lower ever since. Although there's been some deceptive movement along the way, and that's what we want to really focus on. So I'm going to dial us into a 3-month graph to give it a little bit more clarity as far as the upward and downward movement we've experienced since the March 7th high. You see here the market went down 4 consecutive days, only to rise for the next 3, and do so in a fairly sharp manner. And then the market would fall for 5-6 days, hit a bottom and rebound strongly for 4, only to go down 3, up 2, and then 2 really strong down days. This is the kind of market volatility that drives many people nuts. So how can we have coped with this market? You see, VectorVest has again a proven market analysis methodology that can help you cope with even the most perilous of markets like we've seen recently. What I want to do to hit that point home is really begin right at the very market top on March the 7th. One of the most important parts of the VectorVest platform, in my opinion, is and always has been the VectorVest views. You see, it's our daily newsletter, and it's our way to pass along our insights and our wisdom to you, the subscriber. So let's begin there. I'm going to go right up to the top, click on the views, and the first thing we're going to do is go back to March the 7th. You see, on March the 7th, as I scroll down, we have several very important sections that we publish on a Friday. There's a more comprehensive newsletter. So I encourage you, if nothing else, to make sure you read the Friday edition. You see, there's content found on the Friday from our founder, Dr. DeLito, that is priceless. On March the 7th, he kicked things off here, reminiscing about a wonderful call we had in the market back in March of 2009, where we said on March the 6th that the market was itching to rally, only to discover just a couple short days later that the market took off like a bird. And of course, our subscribers made tremendous profits in the market ever since. What he'll then go on to do is pass along a little expertise as it applies to today's market conditions. And it all begins right here. It says here, so here we are 5 years later. The economy isn't great, but it's poking along at 2 to 3% growth rate. Stock markets had an incredible recovery, up 174%. Just as it was in 2009, the jobs report is the headline story. Economists had estimated 149,000 new jobs would be added, but most observers feared a far worse number due to bad weather and sluggish consumer consumption and so forth. But it came in at 175,000, pleasantly surprising nearly everyone. Stock prices took a 2-minute pop to the upside, then headed lower. Why did that happen? He says here, isn't good news supposed to push stock prices higher? In fact, it is, right? But it says here, yes, but that's already been done. The market was low in 2009. Now we're considerably higher, are we not? You know, everything is the polar opposite of what it was 5 years ago. Today's traders are fearful. We've made a lot of money over the last 5 years, and we don't want to lose it. Am I right? 2009 traders, they were hopeful. They had lost a lot of money in the prior correction, and they wanted to make it back and make it back fast. So just as the 2009 traders who were itching to buy thought the March jobs report could have been worse, today's traders who are flush with profits and ready to sell are thinking that the jobs reports could have been better. You know, and isn't that even the case as of this week? I believe we had a good jobless claim number come in just this week, and we've had 2 of the worst down days subsequently. You know, so you got to think about these types of things. The fact is, and here it is in the last paragraph, in bear markets, traders are hopeful and spin bad news to make it seem better, and in bull markets, traders are fearful and spin good news to make it seem not good enough. And that's, again, even what we're seeing this week. So these are lessons of experience that he's passing along to each and every one of us. From here, I want to skip us down to the strategy section, because that's where we discuss how to take advantage of the current market on any given day that you come into the views. This was written on March the 7th, again, which was the absolute top. It says here, last week I said our primary timing indicators, the BSR, RT, and MTI, were not seriously overbought levels, but they are now. So be prepared to see a more difficult market in the days ahead. With 3 yellow lights and an up, the color guard is neutral. It's okay to buy stocks if the market continues to rise, but caution is advised. So at the market top, folks, we're starting to get cautious. This kind of insight is absolutely priceless and worth certainly the subscription price all into its own right. So let's move forward just a week off the top and see what we wrote then. If we go forward to the 14th, right here in the strategy section, will the market bounce back as it's done so often before, or will it continue to move lower? A lot depends on what happens in Crimea and Ukraine. The picture is not very promising, you know, and aren't we still sort of dealing with that situation even today? So these are all news and events that could have consequences on something like corporate earnings and so forth. Could have impacts on Janet Yellen perhaps raising interest rates because jobless claims are doing so well. So the whole mindset of the investor has changed, and he's continuing to pass that insight along. Now, it's one thing to know how the psychology changes. It's another thing to have market timing signals that will give you the action for the events that are occurring. So we provide, of course, the daily color guard, which we covered earlier, the RT kicker and the MACD, and other timing mechanisms where we can take action on these events that are occurring. He says here that all three of those things were telling us not to buy stocks at that time as of the 14th, and it sounds like good advice to him. So let's take a peek at that. You know, we can take a quick peek at the color guard right here in the newsletter simply by going right up to the timing. Here you can see we're transitioning from a lot of green and yellow into just solid yellow. That's a warning sign right there. To dive deeper into the picture, I want to take us into a market timing graph. While a lot of the information I want to discuss is right here, it's better to see it visually. So I'll click right on the graphs tab at the top. We'll come right back into our market timing graph and move forward to the 14th. So here, clearly we see the market has come well off its high, made a week prior. We'll also notice a very interesting thing has occurred with the market timing indicator. And Jerry went over this very well the night of the 14th in a strategy of the week called cashing in at the top. When the market timing indicator gets up into the 1516 range, we state that you are searching for a market top at that stage. Now it can stay up there for a while, but you got to be thinking that the market could turn over at any point when it gets up there. When the MTI gets down to 0.6, 0.5, we're searching for market bottoms. Okay, so again, since we're focusing on the tops, certainly the MTI was beginning to flash some warning signs right up here on that March 7th high. And as the market corrected just over the next week, the MTI fell from up in the mid 1.5s down to 1.22 as of this date. And we'll see that here with a legend on the right. So it's made a considerable downward move gravitating back towards 1, reinforcing the idea that a top may be in play. Another big mover, and perhaps has even more impact, is our buy to sell ratio, which is just below. At the top, we were experiencing 3.1 buy recommendations to every sell in the database. 3 buys to every sell. That's indicative of some strength in a current rally. But watch what happens to that buy-sell ratio as we move forward. Just the next day it drops to 2.7. The day after that, 1 point, so less than 2 buys to every sell. What's happening to the strength of the rally at this stage, folks? Obviously, the strength is dissipating. It's beginning to erode away. And if that's the case, we need to start taking action. We need to start locking in profits, things of that nature, to preserve profits that we have. Of course, as we get all the way to the 14th, the buy to sell ratio has dropped all the way down to just 1.36 buys to every sell. So almost in entirety, the strength of the market has dissipated. Another couple of things we talked about in the essay on the 14th was that the MACD was beginning to flash some warning signs. So if I change our graph layout to the ProTrader DEW timing, and I'm actually going to go to the enhanced ProTrader timing because that has the MACD enclosed in it, we'll see that the MACD actually became bearish. We'll check the levels here. On the 13th, the day before the essay was written. So, and it's really been bearish ever since. You see that? The histogram clearly indicating bearish action on the MACD ever since March the 13th. In just a couple of weeks later, the DPO would in fact confirm that by also crossing below 0 at that time. And if I added on our DEW signal, we will see that, of course, that is the date where we issued a down signal. We had a short little blip up as the DPO kind of oscillated above and below zero here, but it was quickly followed by yet another down signal. It's been bearish ever since. If I switch it to the RT kicker, it's absolutely going to blow your mind. Folks, it just continues to reinforce to me it's one of the very best market analysis models in the market. And to do that, we'll go right up to the top, click on the GLB RT kicker. At the bottom, we need to change it. I'm going to go right to the combo. Green triangles, for anyone new, indicate buying opportunities to go long the stock market. Yellows indicate neutral conditions where you don't want to buy or sell anything to open. You just simply manage the current positions that you have in your portfolio with stops, for example. When red triangles appear, this is opportunities to get short or bearish positions in as either a hedge or a profit opportunity. And so we started to receive those, and these are confirmed green and red lights. Folks, look how it just beautifully gets you in near market bottoms and out near market tops very precisely. So all these situations were lining up. If we focus purely on the moving averages on 314, here you'll notice that the 10 has crossed below the 15 already. Of course, that's a warning sign. You know, Dr. DeLito's been passing along an awful lot of information as of late. Another thing that he likes to use just to speed things up even more is to put on the 5-day moving average of relative timing. If we look at that 5 compared to the 10, we can see down here, let me zoom in, that 5, which is this blue line, is really crossed down below the 10 already and is about to cross down below through the 15. This is a beautiful opportunity to knock some profit off the table. All the information that you need is delivered to you via the VectorVest views and via the product. We just have to open our eyes and look and take the information in and make sure that we don't try to deceive ourselves into thinking that the market is really moving in a different direction. We have to follow and trust and believe in the VectorVest information that's passed along to us each and every single day. Let's go back in the views and just continue to stress the importance. So if I go to the views at the top, let's move forward to the 21st. As we look at the 21st, we'll go down to strategy. It says here that the primary wave is up. However, the price of the VectorVest composite closed at 37.59 on Tuesday after Crimea elected to join Russia without force being used. However, it fell sharply on Wednesday when new Federal Reserve Chairperson Janet Yellen casually said that interest rates might go up 6 months after the tapering process was completed in October. Now, the mood of the market appears to have changed, and it's seriously confused. With a mixture of bullish and bearish signs, we need to be more cautious here. So even though we flashed that primary up wave, we're continuing to hold the stance that now is really not the most opportune time to be buying stocks. Let's move forward another week. If we look at the strategy section here, start right with the second sentence. Given a double-barrel attack of geopolitical concerns and an indication of higher interest rates sooner than expected, the price of the composite fell for 2 consecutive 5-day periods, and the buy-sell ratio fell below 1, giving us a confirmed down market signal. On Wednesday, March the 26th, it's worth noting that since the price of the VVC peaked on March 6th, the DJI has dropped 6.6%, S&P over 1%, VVC over 2.5%, and the NASDAQ continues to get punished this week as well. Money is flowing out of high beta stocks and into more sedate defensive stocks. This is what the specter of rising interest rates will do to a market. If we move forward to the 4th, it says here again, although the primary wave is up, this week's gains were virtually erased by today's sell-off, and we currently have a red light appearing in the color guard. Additionally, remember, we received a confirmed down just 7 short trading days ago. The RT kicker remains bearish, So with one red light and an up, the color guard is mildly bearish at this time. Let's go back to the market timing graph. How good, folks, was the information that we've taken a look at? How good was it over the last 5 weeks? You know, it's been terribly difficult for anyone out there trying to buy stocks long over this past 5 week period. Just about the time you decide to get in is when the market turns around. We're going to keep you from making those critical mistakes. One last little piece of wisdom I want to pass along just before we wrap things up today. It's also good for you to keep an eye on the climate section of the views. It's in there that we take a look at the driving forces behind why stock markets rise or fall altogether. We monitor earnings, inflation, and interest rates as the driving forces behind the stock market. The most critical, of course, being earnings. Earnings is the key. It's an extraordinary correlation that you need to begin to understand. Rising earnings leads to rising stock prices. Falling earnings leads to falling stock prices. So you can monitor it in a couple of ways. If we go right up into the views, every Friday we publish a climate section, and in here we'll tell you whether we're still in a bull market or bear market scenario. Right now we're in a case 4 bull market scenario. There's 8 cases. They do not have to move sequentially. You'll learn all about it if you go back and read an essay called The Truth Chart on March the 21st, 2003. But the one defining factor for all bull market cases, of which there's 4, and all bear market cases, of which there's 4, is the relationship of earnings. We monitor seriously the trend of earnings, and as long as it's rising, you'll be in a bull market scenario. Once we determine it's really heading south, it will enter into bear market scenarios. We can see this visually in what's called the climate graph. So to get there, I'm going to go right up to the top, click on graphs, switch it from market timing to market climate. On the top, we have plotted the S&P 500 earnings. One thing to keep your eye on right now is earnings is really beginning to come down. Now, we track it on a 0 to 2 scale. We got up to a level of 1. Let's just verify it out here to the right. Yep, 1.12. We've come down a little ways from there, and we currently stand at 1.09. So the earning underpinnings of the market is beginning to weaken a little bit, and I think most experts feel like this next earnings season that we're coming up against is not going to be nearly as good as even what we had this past earnings season. We're looking at really, really soft potential earnings coming up. So this will be an important relationship to keep an eye on moving forward from here. So let's go ahead and wrap things up for you and just zoom in again on this last 5 week period. I don't believe there's any other service out there that gives you as much useful information as VectorVest does. And as it relates to this week, certainly I don't feel there's any other service out there that can help you pinpoint deceptive market tops. On March the 14th, 2014, just a few short weeks ago, Jerry D'Ambrosio did a wonderful presentation on cashing in at the top. I want you to know that each of the strategies that he showed in that presentation are up more than 10% to current time. Let's take a quick look at some of his favorites that he was discussing. So if I go to Unisearch, over here on the left, we'll just go down to strategy short. We'll go to ballistic new highs short to kick things off. We'll move back to March the 14th. And I want to end with this. Let's take a look at just the top 10 stocks. How we just simply followed that guidance and taken the top 10 short positions here. They're up more than 30%. 30%. If I sort by percent price, look at this one. Can up there at the top. Well, It's all the way down to $12 a share. It's lost 64% of its value since March the 14th. OHRP is down 48, nearly 50%, 43, and so on down the list. Let's take a look at some of the others. How about Doug's Downer Supercharged? I believe that was one of them, right? Quick test the top 10. Down nearly 19%. That means you're making the 19% because you're short the position, okay? Duck hunting with industry groups was another one found both in the views and also in the Derby from Jerry's tote board instructions. If we quick test the top 10 here, down a measly 11%, but you're making money while the market is falling. Folks, VectorVest has it all. There is so much information that we pass along, from monitoring earnings, inflation, interest rates, to having some of the best market timing analysis money can buy, to also telling you what stocks to buy or short altogether. VectorVest is the only service that I'm aware of that gives you all this information, and in my opinion, it's the best information money can buy at a very reasonable price. Thanks again for tuning in, and we'll see you next week right here at VectorVest University.